Hi everyone, it's Professor Reiko here again, continuing on with our lessons on the accounting cycle. So where we are in the process now, we're still working on adjusting journal entries. So that's step 4 up there in the process, but this is actually our third video on adjusting journal entries. We've talked about deferrals in one, accruals in one, and now we're going to talk about depreciation. All right, so depending on what textbook you're using for this class, depreciation gets in in the KESO book, I believe it is in the deferral section. So remember, deferrals, cash comes first, and then we expense it at the end. So that kind of makes sense here because you the cash up front to buy the fixed asset, and then you expense it through depreciation at the end of each period. The Spiceland book, on the other hand, just has a separate section, separate from separate from deferrals and accruals, called estimates. And they throw depreciation in there. That also makes sense. So it doesn't really matter where they put it. It's still depreciation, and it still works the same. All right, so what is depreciation? All right, so depreciation is just the periodic expensing of a fixed asset over the life of the asset to account for wear and tear and for things becoming obsolete and things like that. So remember, when we buy a fixed asset, just for example, we'll do one at the bottom, but we debit the fixed asset, not an expense. All right. So, and that's what we're saying here. So when we fixed asset is purchased, we're going to debit the asset account, whether it's building, machinery, land, equipment, whatever the case is, not an expense account. All right, so this allows us to keep up with the historical cost of the asset. All right, so the adjustments for depreciation gradually lower the book value. All right, so let's refresh our memory on what book value is. Book value is the historical cost less the accumulated depreciation over the life of the asset. So what you'll see is the historical cost stays the same for the most part, unless you have a capitalized cost, which we'll get to later in the fixed asset chapter. And then we back out accumulated depreciation. So historical cost should stay the same for the most part. Accumulated depreciation is always increasing because it's keeping up with how much depreciation we've had over the life. So the book value of an asset will always be going down. Just a quick reminder, we don't depreciate land. Land is a non-depreciable asset. All right, so let's look at this example here. We purchased machinery on January 1st for $77,000 with cash. The machinery has a 7-year useful life with no salvage value. Okay, salvage value is just what do we estimate that the value of the asset will be at the end of its 7-year useful life. In this example, we're saying we expect it to have no value at all. They use straight line depreciation method. All right, that's the easiest and most common, so we'll just do that here as a quick refresher. And then later in our lessons, we'll talk about different types of depreciation methods. All right, so when we buy the assets, remember we just said when we purchase a fixed asset, we don't debit an expense, we debit the asset account. All right, so on January 1, we're buying machinery. All right, so we'd put that on the books for $77,000, and we're paying cash. So that would be our journal entry to record the purchase of the asset. Right? At the end of the first year, depreciation expense has to be recorded. Now, technically, we could do this each month, but usually for ease of use in accounting classes, we just do it annually, so we're not doing a journal entry every single month for it. But we have to record depreciation. All right, so remember, the straight line method of depreciation follows this formula right here. So this is the annual. Notice that's annual. So if we wanted it monthly, we just divide this answer by 12. Right? So historical costs less salvage value gives me the useful life. Historical costs less the salvage value divided by the useful life gives me the annual depreciation expense. So for our example here, all right, historical cost is $77,000 less salvage value of 0. All right, so we'll put that in parentheses, divided by the useful life of 7. All right, so that gives us $11,000 as our annual depreciation. Once again, if we wanted that monthly, we would just simply divide that answer by 12. All right, let's just flip back here real quick. If we wanted to record the journal entry for that, the journal entry for depreciation is always, so this would be the end of the period, we always debit depreciation expense and credit accumulated depreciation. All right, so that would be 11,000. So remember, depreciation expense would go to my income statement. and accumulated depreciation is on my balance sheet. It is a contra asset. We will talk about that next. All right. So if we flip over here to the next page, we can see talks a little bit about accumulated depreciation. All right. So this is a contra asset account. All right. So remember, we know what an asset is. The asset here is machinery. A contra asset is just something that reduces the value of an asset. Okay. So we have machinery as the asset, accumulated depreciation of that machinery as the contra asset. Now notice on the previous page in that journal entry, it was a credit balance, accumulated depreciation. That makes sense because an asset is a debit balance, so a contra asset should be a credit balance. All right. So the importance of that, though, it allows us to maintain the historical cost principle. All right. So you might have talked about that in your couple of early chapters in your textbook. All right. Because remember, we still are going to show the book value of the asset, but the book value is made up of our historical costs and our accumulated depreciation. All right. So our balance sheet will show both. So here's what our balance sheet would look like for this example. All right. So we'd have machinery of 77, less accumulated depreciation of 11. So the 66,000, this would be the book value. This would be the number that is added into my total assets as far as my balance sheet goes. Now think about if we did this again the next year, so after year 2, the cost is still the same. Accumulated depreciation would now be 22,000 because we would have depreciated another year, and it would be 55,000 being added in. And so you can see at the end of the 7 years, we will have 77,000 less 77,000, and our book value will be 0. Right. So that's what kind of how we're walking through this. That's how depreciation works. There's many other ways to depreciate. Straight line is the most common. It's the easiest. So when we get later in our lessons, when we'll get to a chapter on depreciation, we'll cover other ways, accelerated methods and things like that we can use to depreciate an asset. But straight line gets the job done for the time being. So this is our last type of adjusting journal entry. Remember, we covered deferrals, accruals, and now depreciation. There are other types of estimates that you'll find later in your text. For example, bad debt expense to estimate how much you expect of your accounts receivable that you're not going to collect. Warranty expense. So if you sell a product that has a warranty, how much warranty work you expect to do in the future. Those are both going to be adjusting journal entries as well, but we'll get to those in due time. All right, so this concludes this video. I hope you enjoyed it. Please feel free to subscribe to my channel. I hope you're enjoying these, and please continue to tune in. Thank you.